Stocks selling off today on inflation concerns after a hotter than expected PPI report. Joining us now to make sense of it all is Andrew Graham, managing partner at Jackson Square Capital. Andrew, thanks so much for being here.
Thank you for having me, Caroline.
All right, so stocks are already off the worst levels of this morning, but we're still seeing red arrows across the board here. What's your market outlook, and how does hotter than expected inflation play into that, Andrew?
It's been a very difficult market so far this year. I think when you look at all the single stock volatility that we've experienced, I think it's a win that the S&P is roughly unchanged year to date. On the PPI print, I got to remind myself and maybe the viewers that it's January and you have January resets that regularly take place. So it's you usually get a hotter print in January CPI and PPI. Our forecast is for core PCE to make its way pretty close to the Fed's 2% target by year end. So we are definitely looking for 2 cuts, which the market's priced for, and maybe even 3.
Okay, all right. I should note that today we're actually seeing the NASDAQ faring best today, but not thanks to the Mag 7, which is mostly lower. I'm curious, you talk about this being a very difficult market. We've obviously been seeing a lot of rotation. Do you think that the easy money in mega cap tech is officially behind us?
For now it is. Yeah, I mean, the business model has changed. The CapEx spending goals this year are high enough to chew into operating free cash flow, and they're just unable to do the stock buybacks that they did before. So there's just a lower return to shareholders, and shareholders are putting incremental dollars elsewhere, and maybe there's some rotation going on as well. And that rotation creates a market cap mismatch. You're going from, trillions of dollars of market cap, say for Microsoft, and incremental dollars are flowing into much smaller markets. And I think that's also generating some of the single stock volatility, along with, of course, the implosion in software stocks this year.
Okay, so you say for now it is. Is this a real changing of the guard for the rest of 2026, say, or is this a temporary pit stop here?
It's a temporary pit stop. CapEx is going to peak sometime this year. Operating free cash flow is going to trough, and these stocks will re-rate higher. I think it'll happen probably in Q3, maybe Q4. So no, this is a tough time for the average investor. I would say the hunting's been very good, though, for professional investors. So this is definitely a stock picker's market. And while the S&P might be flat, professionals are putting up double digits in most cases. So it's been, I guess, from our perspective, an easier market to beat the S&P. But we understand the frustration is just not as simple as, hey, I'm going to own those hyperscalers, or I'm going to buy the S&P and sit back and get a mid-teens return.
Okay, so very much a stock picker's market. We have some of your picks that we'll get to, but I do want to ask, because this is a short-lived kind of blip versus a permanent changing of the guard, does that mean you're buying any of these tech dips that we've been seeing so far this year?
For us, the tech menu is pretty much confined to networking equipment. I mean, that's where we see the most earnings growth, the most durable earnings growth. These stocks don't trade at a huge premium to their pre-AI multiple, probably about a 25% premium to their multiple before they had the AI-based revenues. As a group, I'm not even picking out the best names, but as a whole, the networking equipment names are guiding to 60% revenue growth, 80% earnings growth, and again, trading at a 25% premium to their pre-AI multiple. So we have our favorite picks. We like the optical transceiver names, which have done very well thus far year to date. And we see that continuing. The scale up architecture that's going on, basically adding density to server racks and increasingly adding density and then going to faster rate speeds from 800G to 1.6T. That's all driving higher attach rates for companies like Coherent and Lumentum, but Coherent's our pick. That the company has made an effort to secure the necessary materials to meet the demand, in our opinion. And we also like Amphenol, which is within the server rack rather than connecting racks together. But those are our 2 picks.
Okay, the only issue with Coherent and Amphenol, I'm taking a look here. Coherent is up 40% so far in 2026 and 270% over the past 1 year. Amphenol up a little bit less than that, about 7.5%. so far this year, up 130% over the past 1 year. If you didn't buy these already, is it too late to get in?
So everything's consolidating right now, Caroline. So we're going to let that happen. That usually takes a week or two. There's sort of a momentum unwind that's going on. I saw, Coherent's up today, which is fine and nice. I would love to see it back to give us a chance to reload. But this is a multi-year story. So you're gone from scale out to scale up to scale across, and the optical transceiver names are going to be there the whole way through. So that's, for us, a long-term name and a big winner. I think the excitement is still to come in names like Coherent, where especially you've got backlog. You can't reprice your backlog, but all the new orders that are coming in just based on the demand are priced higher than before. So we expect margins to accelerate for that name in particular.
Okay. Another one of your picks is Ivanhoe Electric, ticker symbol IE, a copper play. I'm assuming that's also linked to AI demand here and electrification.
Yeah. So money's moving from west to east, right? It's moving from into high, moving into all the value and cyclical stocks. And so we do have exposure there. We have a couple of names that we are been buying recently, but yeah, Ivanhoe's one of them. So Ivanhoe has, as the name implies, Ivanhoe Electric, a sort of a electrification business that definitely is a beneficiary of all the data center build out. But they also have the second largest copper mine in North America, which is coming online this year, and copper's in high demand during a cyclical acceleration, which is what is going on right now and what we expect to continue at least into the second half of the year.
Okay. And finally, Howmet Aerospace, HWM, a defense play. Tell us why you like that one right now.
Well, it's commercial and defense aerospace, and so you're getting parts for jet engines and things of that nature. But it's a diversified industrial. So they make titanium wheels for trucks and for cars and things like that as well. So we wanted to have multiple channels anyway. It just so happens that defense is in fashion. The stock's done really well this year. It's also in consolidation mode and giving us a chance to reload. And again, the timing on that probably within a week or two.
Okay. I hate to call them under the radar picks, because if you take a look at these 1 year charts, they're very impressive. So they've certainly found buyers, but not necessarily the names we talk about daily. So we appreciate those. I'm curious, if someone is watching right now and they own a lot of mega cap tech, what's one adjustment you'd suggest right now?
So I would go with the flow a little bit. I think it should be, for the average investor, maybe it's not that easy or whatever. You're not comfortable buying a mid cap or small cap stock like Ivanhoe Electric or whatever, but you can buy maybe the ETFs, and the mid cap ETF, maybe IJH or something like that is I think something to add. Just in the near term, I'm not sure you're going to make it 12 months to get long-term capital gains on the cyclical value stuff. So we generally try to do that, within a retirement account, so an IRA or something for the average viewer. So that's, something to add in addition. It's very hard to take, gains that you've had that are, 10, 12 years running, and you've got these massive gains. Mm-hmm. I think you're going to be okay 2 quarters from now. I think they're going to come back. I'm talking about the hyperscalers, the Mag 7, so to speak. But in the near term, if you want to get some performance, then we recommend adding the cyclical value stuff.
Okay, Andrew, I think that's a great segue into our rapid fire this or that round. Are you ready to play?
Not sure, but yeah, let's play.
But here we go. All right, remember, quick answers here. Hyperscaler CapEx, growth accelerator or profit killer?
Profit killer for now.
AI spending, still early or starting to cool off?
Still early.
Market leadership, big tech stays on top or new leaders take over for the longer term?
Big cap stays on top if we're talking longer term, but you got 2 quarters here, I think, where the cyclical value stuff continues to play out and work. Cycles don't usually last that long. Sorry, this is a long answer. But these cyclical accelerations don't usually last that long. But don't blink, get it while you can, and I think there's more upside there.
Okay, so tech pullback, opportunity or warning sign?
Eventually an opportunity. And software is a little bit unique. We can go into that, but I know we're in the lightning round, but happy to talk about that. I think it's going to take a while for software.
What's a software name that you would actually feel comfortable buying here?
So I would go probably CrowdStrike and Cloudflare. There's a couple names to mention. I'm not sure. We're not adding them at the moment, but those are two that are on our list. They're both sort of security-based software.
And what are you absolutely avoiding?
Anything that can, is just coding based that can be replicated. The cost of coding is going down, obviously, so customers are going to be pushing back, I think, a little bit on price. You've got this whole thing is creating, I guess, enough of a distraction for customers to hold back orders. So that's going to go on. I see estimates being revised lower. And then software companies have a lot of stock-based compensation, and when you're underwater with your RSUs and your options, you're probably not a happy employee, and I think these companies are going to have to start paying higher cash-based comp going forward.
Okay, back to the rapid fire. AI taking over software, real fear or overblown then?
Overblown.
Stock picking in 2026, stick with proven winners or rotate into new names?
Rotate into new names.
And finally, cyclical stocks, oversold or still risky?
Oversold.
All right, we'll leave it there. Thanks so much for playing along. Really appreciate it, and also appreciate your picks and your insights, Andrew. Thanks so much.
Thanks, Caroline.